Welcome to the Fear and Greed Business Interview. I'm Sean Aylmer. Earnings season is upon us again. It's an opportunity to find out not just how companies have performed, but perhaps more importantly, what the outlook is like. This morning, we're going to take a look at some of the companies and trends to watch this earnings season. Remember, this is general information only, and you should seek professional advice before making investment decisions. Anna Milne is a senior investment analyst at WAM Leaders, a listed investment company from Wilson Asset Management. Anna, welcome back to Fear and Greed.
Thanks for having me.
Broadly, what are the themes we can expect over the next 3 weeks or so?
So this has to be prefaced by saying we are in a very momentum-driven market.
Yes.
And earnings season can really test this momentum. So when we're thinking about what's in focus, we're looking at whether the stocks that have really run quite hard and have had this significant valuation expansion, whether they can now justify that with the earnings they're going to print and the outlook that they will talk to. Based on what we've seen so far, if you meet earnings but talk to a better outlook, you will tend to be treated okay. If you meet earnings but there's probably nothing left in the trade, there is potential to be hurt by the market. When thinking about sectors more broadly, with this
Hold on, you missed the other one. What if you don't meet market and you don't like the outlook?
I think there'll probably be a few of those candidates this season,
Right.
Just given how far things have run. And that is exactly what we're looking for. So we have the banks, which are a beast unto themselves, and we won't have fulsome updates from many of them. We will get CBA, so we'll be looking at that very closely. We have the discretionary retail names. JB Hi-Fi has ticked over $100. So that feels like it could be potentially defying gravity slightly. Although in saying that, feedback for November and December has been quite strong, but that one will have to beat numbers to really see support, as well as other sectors such as technology and what I call market beta. So stocks that are exposed to broader markets have run quite hard as well. So we're watching for those ones with a little bit of caution.
What about, JB Hi-Fi, CBA, they're both stocks, they're not quite re-rated, they're just highly rated. Maybe CBA has been re-rated, it's done so well. Can they keep it up? I mean, it must be very difficult for a company, and I'm saying generically, I'm not specifically asking for Commonwealth Bank or JB Hi-Fi. When they run so hard, though, you're kind of asking for a fall sometimes.
You are. You certainly, when we think about stocks, you have two drivers. You have valuation, you have earnings. And with valuations being so stretched, it really takes this driver out of the mix. So you're relying so heavily on those earnings to come through. Whereas on the downside, you have the valuation downside, but you also might have earnings not meeting expectations. So certainly you have to be a lot more high conviction on the investment thesis when valuations are at the top of their range or have re-rated, as you said.
Can we look at some sectors? Consumer discretionary, let's start there. You mentioned JB Hi-Fi. I might be wrong, but I think year to date, consumer discretionary is probably done as well as any of the other sub-indices on the market. Wesfarmers is a big part of that. We're expecting a lot from Bunnings there and potentially Kmart. Harvey Norman will be interesting. I mean, what do you expect to see from some of those stocks?
When we look at high-frequency indicators for the Australian consumer, things are holding up relatively well. We have retail sales data, we have building permits, we have government spending, and it does feel like these numbers really are trucking along. But I would say that the market forecasts are broadly correct. So we aren't expecting any significant upgrades to earnings for any of the consumer discretionary names. Those names you talk to being JB Hi-Fi, Wesfarmers, Harvey Norman, for example, they all have very stock-specific hits and misses that investors are watching really closely. So as you said, for Wesfarmers, Bunnings has always been the absolute crown jewel, but more recently in the last year or so, the focus has really shifted to Kmart, and not only how well it's doing in Australia, but the proposition for Anko overseas and things like that. So the devil will probably be in the detail with a few of these names.
What about the tech stocks? Again, a sector that did very well last year, and companies like WiseTech. Well, I mean, WiseTech's sort of an incredible company, though it has had sort of off-balance sheet issues going on. But REA, Xero, REA reported last week, did really well. Can they keep going?
REA is one that I've been spending quite a lot of time on even today. Its result on Friday was good. It was a shock that the CEO, Owen Wilson, resigned, and certainly that's a negative for the name. He's very well regarded in the market, but it continued to run again today. So I think that does mean that those stocks that are loved, even if there is momentum, if there is enough to show earnings support and potential upside to the outlook, which is what REA talked to, they can continue running.
In a moment, I want to talk to you about some of the specific companies you're keeping an eye on, Anna. We'll be back in a minute. My guest today is Anna Milne from Wilson Asset Management. What about the telcos? Not a huge sector, except for Telstra. There's also Spark New Zealand in there. Telstra's sort of one of those stocks that a lot of us own because we have always owned, but I don't know, it hasn't done a lot.
Yeah, you're right. It hasn't really done a lot. It has felt like it's potentially been somewhat dead for a few months, as we might say. But there are still a lot of great factors going for it. The mobile market continues to be rational and is holding strong. The dividend will be increasing. It's fully franked. It's a great income earner for Australians that invest in Telstra. But I'm beginning to wonder if maybe the mobile market is turning a little bit. If the price increases that Telstra is putting through maybe aren't sustainable, if the peers being Optus and Vodafone aren't following. So we're watching that really closely for Telstra, actually. Spark, on the other hand, is a deep value play. It's trading at close to decade lows.
I love the phrase deep value. It's just cheap at the moment relative to history, but that doesn't mean that it's going to outperform. I mean, that's an explanation rather than a comment. Is that right?
Yes, that's right. And deep value has not won you many friends in the last few years because the market has been so momentum focused. But this is a stock it's the Telstra of New Zealand, and New Zealand economically has been a lot more challenged than Australia. And there have been a number of stock-specific issues on top of that. But it's reached a point now that we look at the value of the non-core assets that they're trying to sell versus the quality of the franchise, that once the economy recovers, their earnings should too. So that's one that we're looking at. I don't necessarily think it's going to have a good update this month, but more over the medium term.
What about the property companies? Dexus, Centre, GPT, Goodman, of course, is the leader. Given the interest rate environment, that has a big impact on those guys. What do you think they'll tell us this earnings season?
What we are expecting to hear from the REITs is quite interesting. I think across the board, we're expecting that cap rates have close to bottomed, or valuations have bottomed rather. Cap rates have topped out. And in the last couple of years, every single subsector of REITs has suffered from valuation declines. Industrial, retail and office, particularly office. But office really seems to be at an inflection point, particularly in core markets such as the centre of Sydney. Vacancy is actually improving. It's really holding up. This return to work story is coming to the fore as employers ensure that their employees are coming in at least a few days a week for productivity and the like. So we actually really like Dexus for that reason. It's extremely undervalued. It's trading at a 30% discount to asset value for assets like the building that I'm sitting in, which are not really very replaceable anymore for a similar cost. Centre Group, very interesting. I think the retail sector is set up very well for REITs over the coming years. We're not having any more malls built in Australia, and yet our population growth continues. We've also really had the shakeout of the online story, and most retailers have settled for an omni-channel approach. They have the bricks and mortar store, and then they also have the online, and they work quite well together as a model. And then Goodman is the darling, as you say. I think this is more a macro trade than anything fundamental. So that really does come down to what happens to bond yields over the next month.
Okay, let's finish off with healthcare, which I'd like to get enthusiastic about healthcare because it's a big part of our market. I've got to tell you sometimes. CSL, leader in its field. ResMed's a leader in its field. And then you kind of have a bunch of other plays in that sector. What do you think? Well, healthcare I can't get my head around because some of them do really poorly and some of them do really well. And there doesn't seem to be that many in the middle, but maybe I'm making that up. How do you think they'll go?
You're completely right. It is the haves and the have-nots in Australian healthcare. You have, as you say, the global leaders being CSL, Cochlear, ResMed, Fisher and Paykel as well. And then you have healthcare services, which have just been so troubled for the last few years, given labour costs, given relatively low top-line growth. Ramsay, Sonic, Helios have really suffered. So we can't really get too excited about healthcare at the moment either. CSL has come off slightly, so that makes the setup into the result look a little bit more interesting. But I am quite cautious on the trends for CSL, so I'm not really at the point yet where we're wanting to wade in further in a big way. They have had challenges with Vifor, the business they purchased a few years ago. Seqirus, which is their flu business, has had a relatively poor season this year in the Northern Hemisphere, despite flu season being quite bad. That's because there are less vaccines in arms, and that's where CSL comes into things. And then the crown jewel for CSL is the Behring business, and there are a few question marks around the performance of Behring as well. So we are a little bit cautious on CSL into the result. Resmed actually had what we thought was a good result last week and traded off quite sharply. So I would prefer to invest in Resmed than CSL at the moment. And Sonic, I think, is another name that's looking quite interesting because it is quite unloved, as you said, but they've actually been growing quite strongly from a revenue perspective, and it feels like their cost pressures are easing. So that's one that we're watching closely too.
And at this point, do you get excited about earnings season, or you just think, I'm not going to see my family for the next 3 weeks?
I love it. You have to love it in this job. I look forward to it.
You do, actually.
I just absolutely love it. It's so much fun. Busy days, busy evenings trying to get your head around things, and then back into it the next morning.
Thank you for talking to Fear and Greed.
Thanks, John.
That was Anna Milne, Senior Investment Analyst at WAM Leaders, a listed investment company from Wilson Asset Management. This is the Fear and Greed business interview. Remember, this is general information only, and you should always seek professional advice before making investment decisions. Join us every morning for the full episode of Fear and Greed, daily business news for people who make their own decisions. I'm Sean Aylmer. Enjoy your day.